One of the things we're going to look at today is the possibility that the S&P 500 is forming a head and shoulders reversal pattern on the hourly charts. Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, February 19th, 2021. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. So the first chart that we are going to look at today is an hourly candlestick chart of the S&P 500 that goes back 1 month. And what I am seeing here for this week, and we'll look at weekly numbers and things here in just a second, but I think one of the most important things that I'm seeing, and this is really very evident on the hourly chart, is this possibility that the S&P 500 is forming a head and shoulders reversal pattern. So what I'm seeing here is this neckline that's forming around this 38.95 area with the left shoulder right here. We've got the head of this head and shoulders, possible head and shoulders reversal pattern right here, and here's the right shoulder right here. All right, so you can clearly see this pattern, and we don't know, guys. We don't know whether this thing is going to materialize or not. It's, with all the stimulus out there, it's completely possible that the market, just next week just takes off and rallies and moves up closer to that 4,000 level on the S&P 500. However, we don't want to ignore this, okay? And so this 38.95 area, plus or minus, is going to be very critical, because the way these things normally work is, if this is truly a head and shoulders reversal pattern, once you break this neckline, that's when the market really starts to roll over. And you can see that we have consistently closed above the 38.95 area on the hourly candlesticks going clear back to February 8th. So for the last couple of weeks, we've been able to stay above on the hourly closes, right? We've got a few tails. I call these the tails of the candles, right? We have a few of these tails that have dipped below the 38.95 area, but on the hourly candles, you can see that every single one of these has closed above the 38.95 area, this blue line here, since back on February 8th. So that's why this 38.95 area on these hourly candles is going to be so critical. So we'll have to watch this, and in the next chart, I'll show you some potential downside areas if indeed we do start to break beneath this 38.95 area over the next few days or few weeks. The next chart that we're going to look at is an hourly candlestick chart of the S&P 500. However, this one goes back to the end of 2020. So December 31st is right here, and I left December 31st in there so we could see, where we started off the year. All right, because 3,700 is kind of where, we started the year, and then we round tripped in January. We pulled back down to 3,700 on January 29th, and then for the month of February, we've had a pretty good month here. This is where all the progress for calendar year 2021 has been made so far, and you can see we started off right here at 3,700. We made our way all the way up to 3,950, just kissing this area briefly on at the beginning of the 16th there, at the beginning of this week on Tuesday, keeping in mind this was a shortened trading week because the markets were closed on the 15th on Monday. So we gapped up and hit the highs of the week, as you can see right here, and right around this 39.50 area on the wick of this hourly candle, and then kind of just slowly, ground our way lower, and didn't close at the absolute lows of the week, but near the lows, and you can see this kind of downside movement. Now, if we break beneath this 38.95 neckline area that we were just looking at, the downside support areas that I'm going to be watching will be 38.60. You can see there's a little bit of trading, right, where we got up to this area in the third week or so of January. kind of hit our head, so to speak, on the 3860 area, and then deflected lower from there, bounced off of the 3700 area and back up. So 3860 is, the first logical area of support if we break beneath that 3895 neckline. So 3860, if we're lucky, that'll be as bad as it gets, right? There's some additional support here at 3820, but you can see there's not a ton of trading. And, we might get lucky. 3840, I didn't draw a line in there, but you can kind of see a little bit of trading right here. But again, not much, right? Just a few hours. We've got a few days of trading right here at 3820, but the real support areas beneath where we are currently trading, 3860 and then 3700. So if indeed we are rolling over at this time, those would be the critical areas that we would want to watch, 3860 and 3700. The next chart that we're going to look at is a weekly candlestick chart of the S&P 500 that covers the last 4 years. The blue line is set at 3510. We'll talk about that in just a minute. And this green wavy line, that is the 40-week moving average of the S&P 500. Of course, the 40-week is equivalent to the 200-day moving average. And where we closed this week, we are still 13%, a little bit more than 13% above the 40-week moving average. So that's a pretty good gap there. And you can see, just eyeballing this, guys, if you go back over the last 4 years, and this is why I wanted to leave this this chart to a 4-year time frame, is, you get these big gaps here. They generally resolve themselves with you pulling back to or below the 40-week moving average. So big gap, pull back, big gap, pull back, gap, gap, gap. And you can see that, in the majority of cases over the last 4 years, and you can take this type of a chart back, 10, 20 years, and you're going to see the same pattern, right? Whenever you get a big gap like this, at some point, this gap resolves itself by you pulling back to the 40-week moving average. Not every pullback results in you going all the way, as we saw here. We pulled partially back, right? But either way, it's been a while, right, since we've, been down to this 40-week moving average. So at some point, maybe we started it this week. It may not happen for another few months or so. We don't know, okay? But at some point, we need to expect a pullback to the 40-week moving average. That's just the way the markets work. Now, the S&P 500 was down 71 basis points this week, and of course, this was the first week where we were negative over the last 3 weeks. And we've had a pretty nice run here, really, since the end of October, beginning of November, where you can see the market has just, steadily climbed with an occasional negative week, but then we get right back to this uptrend. And so again, it's completely possible that, next week is a positive week and we get up closer to or even hit the 4,000 level on the S&P 500. We're not that far away. However, if we are rolling over, you can see on these weekly candles, there's really not much support below where we're trading until we get down to this 3510 line. This is why I put that in there. So on the weeklies, you can really see that the real strength below where we are currently trading, which, by the way, we closed at 3906.71, and this is only the second week where we've ever closed above 3,900 on the S&P 500. So, we're still not that far off of the all-time highs, but 3906.71 for the weekly close here. But if we are rolling over, even before we get to the 40-week moving average, which, as we know, would be a little bit more than the 13% drop below where we're currently trading, this 3510 area would come into play, and we might get lucky, again, assuming we fall beneath this 3700 level and continue to correct down, whether it's over the next couple weeks or whenever. This 3510 area would be the first real support level below where we are currently trading, the real big support levels, okay? These like 3,700, 3,860, those are more minor support levels. Obviously, 3,700 is going to be more important than 3,860, but on these weeklies, you can clearly see that the 3510 area is going to be much more important than either one of these two support levels, okay? So, Guys, at some point we're going to get a pullback. Maybe it started. Maybe this head and shoulders reversal pattern that we're seeing in the hourly charts, maybe this is real, and maybe, next week we start to close beneath 38.95 on the hourly candles, and of course on the dailies. That would be the first real indication that this is actually happening. And then again, we need to watch the 3860, 3700 level. But beyond the technical analysis, guys, I want to encourage you to have a risk management model. Now, I love technical analysis, as I think you can see here, and I'm pretty good at it. Been doing it a long time. But pure technical analysis by itself, I don't think is enough. I think you need a risk management system, and this is why for myself, I spent over 20 years developing a risk management system to help me not only on the downside, but on the upside, right? To help me understand when it's safest to stay invested, whatever my maximum percentage of equities is. I want to know that. I want to have an advantage. And after working on this model for 20 years, it finally came together for me in 2017. And after I worked with it for a few months, I realized what I had. And of course, I've now formed a business around this, and I'm providing this information to you guys. So, I spent 20 plus years of my life creating this model that really, really helps me. I want to encourage you to spend the next 15 to 16 minutes of your life watching the rest of this video to learn more about how this model, it's called Simple Market Signals, how this can help you in both up and down markets, guys. This is something that can make a huge difference in your life going forward, whether you have, $10,000, $20,000 in the markets, or hundreds of thousands, or even millions, okay? And whether you're trading a margin account, your IRA, your 401k, this will help you in any of those situations, and it helps whether you have straight up exposure to the S&P 500 or whether you're trading individual stocks or options, okay? Because keep in mind that 90+% of all stocks go in the same general direction as the overall market, and the S&P 500 is by far the best proxy for the U.S. stock market, okay? So with that said, have yourself a great weekend. Thanks for watching this, but please stay engaged with the balance of this video because it could make a big, big difference in your life going forward. Let me ask you a question. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases. And then I created simple, easy to understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's two major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. A quick review of the risk signals. The green signal is the best risk-reward ratio signal for equity investors. And what you're going to find is that most upward progress in the stock market will happen in a green signal environment, as we see here. The red signal is the worst risk-reward ratio signal for equity investors. And what you're going to find is that the worst downturns, including the downturn in Q4 of 18 and the bear market in Q1 of 2020, plus the bear market from 2000 through 03 and the bear market of 07 through 09, all of those are going to take place in a red signal environment. Now let's put it all together and see how simple market signals could have helped you during the fastest bear market in history, which of course happened during Q1 of 2020. We had a strong stock market coming into 2020, so the risk signal was green coming into 2020 and remained green for the majority of January. We did have a yellow signal for about 2 weeks towards the latter part of January, first part of February, and then, of course, the risk signal went back to green. And then on February 19th, we hit what was at that time the all-time high on the S&P 500. Again, that's February 19th. And then things started to unravel from there. But think about this. Just a few days after the all-time high at that time in the S&P 500, on Monday, February 24th, the risk signal went yellow. And then on Tuesday, the 25th of February, the general trend indicator went negative. And that general trend indicator had been positive since October of 19, okay? So right there, just a few days after the all-time high in the S&P 500, the risk signals started to tell you that something was changing, that there was increasing risk in the stock market. And by Thursday, February 27th, the risk signal was red. And then, of course, the market sold off hard from there. So think about this, guys. I mean, you talk about stress testing my model. During the fastest bear market in history, that started just a few days after the all-time high at that time, the all-time high in the S&P 500, in 1 week, the risk signal went yellow, the trend indicator went negative, and then the risk signal went red, all in the same calendar week, actually within 4 days, right? Monday, Tuesday, and Thursday. So you talk about stress testing my model. Guys, I mean, this is the fastest bear market in history, and look at how simple market signals could have helped you during that time. With simple market signals, you will know what the risk level is and what the trend direction is in the overall U.S. stock market. And the proprietary model is based on S&P 500 data. The S&P 500 index really is the best proxy for the overall U.S. stock market, and it's the only index that has all of the data available that I need to run the model. And guys, it's not about beating the S&P 500. However, that is a possible outcome over time if the tools within the model are employed properly. It's about risk management and risk control. It's about controlling your risk exposure rather than letting the whims of the market dictate your future. The best fit for simple market signals is an investor or a financial professional with at least a 6 to 8 week plus time frame that they're focusing on. If you're a shorter term trader or a day trader, simple market signals may help you a little bit, but the reality is that the best fit between simple market signals and a subscriber is somebody that has at least a 6 to 8 week time frame or more that they're focusing on. These signals are delivered to subscribers in our weekly emailed newsletter. As part of the Simple Market Signals weekly newsletter, you will receive the proprietary risk level signal and charts on the overall U.S. stock market. You will also receive the general trend indicator signal and charts on the overall U.S. stock market. You will also receive a weekly recap of what happened in the U.S. stock market, including performance information and charts. And this is on multiple investments. So we cover small caps, mid caps, large caps. So you'll have a great idea of what's going on in the entire U.S. stock market across all capitalization. You will also receive technical analysis data and charts, so things that are interesting and educational that I think is important for you guys to know will be included in the newsletter on a weekly basis. You will also receive fundamental analysis data points on the S&P 500, so we look at potential earnings per share for the year, as well as the possible PE ratios, and then price levels looking out to the end of this year, and then I generally go out to the end of the next year as well. So you'll have great fundamental analysis data to work with on the S&P 500 right at your fingertips every single week. You will also receive yield curve information and data points. So we look at the 2s and the 10s. So the 2-year Treasury note, the 10-year Treasury note, and then the spread, the differential between the 2s and the 10s. This information, guys, very few people know about it. Very few people watch this. This is so important to really get your head wrapped around because it affects so many areas of the financial markets. And you will also receive the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall market, but we also give you the risk level signal on all 11 major sectors of the S&P 500. So you can see what the risk level is underneath the hood on all of the individual sectors. And you will also receive sector performance information on all 11 major sectors of the S&P 500 over multiple time frames. So guys, you're going to get all of this, right? And it's going to make you so much more knowledgeable about the financial markets. You're going to be able to have a conversation with virtually anybody about the stock market, and you're going to be able to really understand things at a level that very few people do. And guys, you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. I want to set realistic expectations. The weekly emailed newsletter isn't fancy. It's effective. It's plain text, no color, other than the charts, of course, and no fluff. But it's chock full of extremely valuable information week after week. And please note, due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. Just go to simplemarketsignals.com. That's https://simplemarketsignals.com. It'll take you about 4 or 5 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system, and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. A few points to remember with respect to your subscription to Simple Market Signals. Remember that everything is tied to your email on file. Now, once you subscribe, you will get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter, so that's automatically generated from our system. And whether you see that welcome letter or not, I would encourage you to double check your spam, junk, trash, and promotion folders, especially for the first several weeks of subscription, because once in a while, our emails get automatically routed into one of those different folders depending on your email service provider, whether it's Gmail, Yahoo, whatever it may be. And I would get in the habit, I would encourage you to get in the habit of every week or two, just go out real quick and double check these different folders, the spam, junk, trash, and promotion folders, because I can't even tell you how many times I've had people say, well, I didn't get the email, and then when I tell them to go out and check those various folders, oh, there it is. So it's just, the reality of having an emailed service that once in a while, and it's going to vary from email service provider to email service provider, but once in a while, the emails from us, depending on the subject line and other things, will get automatically routed into one of those different folders. Also, I would encourage you to whitelist all emails from Simple Market Signals. In other words, just make sure that your email service knows that you want all Simple Market Signals emails to go to your primary in basket. Also remember that newsletters go out on the weekend, okay? They generally go out Saturday afternoons, but they could go out anytime over the weekend depending on our production schedule. And the next new edition will be sent to you on the weekend following your subscription. So if you subscribe on a Monday, Tuesday, Wednesday, whatever it is, the next new edition is going to come out on that weekend following your subscription. But we will also send you the latest edition. So whatever the most recent edition of our newsletter was, we'll send you that latest edition as soon as we can, but we have to manually send that to you. Generally, you will receive that within 24 to 48 hours of your subscription. So again, if you don't see that first newsletter within 24 to 48 hours, go back and double check your spam, junk, trash, and promotion folders to make sure that it's not hidden in there. Also, within that first 24 to 48 hours, we're going to send you at least one or two emails with links to training videos that are for subscribers only. So please make sure that you're looking at all of this, because it's extremely important for you to get the most out of your subscription. Please watch those videos that are part of the training material that we send you. Now let's recap what you will get with your Simple Market Signals subscription. With your subscription, you will receive the weekly emailed newsletter, which goes out on the weekends, that will include all of the content that we just talked about. Plus, you will receive midweek update emails when warranted. So if there's a major signal or trend direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to send a midweek update email to get you that information as soon as possible. So again, a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. To get started, just go to https://simplemarketsignals.com.